All right, all right. Welcome, guys. Hello, hello. How's it going? Welcome to We Talk Money. This is our first live in quite a while.
Love it. Glad to be here. It's exciting. 420.
Yes. Hope everybody's doing well. Kind of a interesting week. Got a lot to chat about. And yeah, let's just make sure that everybody can hear us and see us. You guys can hear us okay. Let me know in the chat. There is an echo. How's the audio for everybody else?
Testing.
Testing.
All right. Yeah, I guess Trav and Nick, just make sure if you have the YouTube up that's muted on your end.
Yeah, mine's muted.
Cool.
Mine's muted.
All right. Well, let's go ahead and jump straight into it then. Jump into the charts and then into the news. So just kind of getting everybody caught up since, we went live last time. Price on Bitcoin is basically flat. I feel like that's been the story for over a year. If we take a look at the NASDAQ, we are basically flirting with the potential for an inverse head and shoulders here. Or are we going to snap below multi-month support and make lower lows? What do you guys think? Anything you want to look out on the possibilities or the probability side? Any strong beliefs or thoughts?
Yeah.
I personally, sorry, Trav. I was just going to say, I personally think that Bitcoin and even the broad indices, we are still holding up. We're still holding a higher low. So until that breaks down and we retest all-time lows, I'm saying it's anyone's game.
Yeah, I think no one knows anything because you've got, I think today one of our community members was calling out that the indices look like they're putting in like an inverse head and shoulders, which could mean maybe another bounce. And then, of course, you have, major tech stocks like Netflix selling off almost 40% today on pretty rough earnings results. And so you've got that backdrop plus, lots of other companies set to report. And lots of concern over things like inflation still out there, bond yields, mortgage rates higher, obviously. So there's a lot of fundamental stuff that still makes a lot of people bearish. When you look at the sentiment readings, you can see that as well. Like sentiment is highly bearish across a lot of the sentiment gauges. Lots of concern over things like inflation. So it's really hard to say exactly where it goes, especially in the next couple of weeks. But I still remain pretty cautious overall myself. But could we see the indices rip? Absolutely. I think that's definitely possible, just because we are set up in a way where a lot of people are bearish and the markets could just go higher into summer and really put max pain on everybody.
So talking about Netflix, is down over 20%, lost several 100,000 subscribers. Is this the end of Netflix? Are you bullish, bearish? What do you make of this? And is this a bellwether for anything, or is this just kind of a one-off event that is probably not that big of a deal?
Trav, you want to take this or?
Well, I'm not the technicals. I'm not the expert in the technicals, but yeah, I just, like I said earlier, I remain concerned about some of the fundamental backdrop. And I said yesterday to people in the community that it was going to be really telling what happens with Netflix, because we saw in Q1, the earnings season was really rough. We saw a ton of stocks gapping down, even when they had earnings results that met expectations. And so the bar was so high for stocks last earnings season that, you really had to blow out your numbers or your stock was going to get whacked. And we had a lot of gap downs and a lot of popular stocks. And so I said yesterday to everyone, well, let's see how the early tech stocks do in earnings this week and next. And that may tell us if we're going to see a repeat of what we saw in Q1, or, could we actually have stocks start to act better and gap up on results that are maybe not as bad as feared? Well, then, of course, we go and look at Netflix. Their subscriber numbers are actually declining slightly on a sequential basis. And there's questions now about the long-term growth rate. And so there's all these concerns cropping up. and the stock is down almost 40%. You know, this is a large cap, highly held, highly loved tech stock, and down almost 40% today in one day. So it's pretty shocking, actually. And it's not a great sign. Maybe Netflix is an outlier. Maybe, you know, the post-COVID issues are unique to Netflix, or maybe just a handful of stocks. But again, I'm still concerned about how the market is reacting to earnings. I'm still concerned about corporate margins as we go through the year with this high inflationary pressure. And we still haven't gotten a ton of relief on energy. We saw crude oil, natural gas, all up a lot last week. In fact, natural gas was up like over 20% last week. It is pulling back a little now, but crude as well, up almost 10% last week. So the inflationary pressures are not really going away yet. We talked about the high CPI that we had last week, the high PPI. So the fundamental backdrop really hasn't changed. I don't see anything that changes my mind from a fundamentals perspective. But again, in the short run, anything can happen, you know, and things can run, you know, against the conventional wisdom in the short run. So again, it's anyone's guess.
I do want to kind of talk about Netflix for a second, because yesterday I was, you know, looking at it, and we were talking about it in chat about where it could show value. And when you compare Netflix, which isn't really, it's a great business, but it isn't really a diversified business, which is something that kind of concerns me. I know they're trying to get into gaming. They've made some acquisitions to get there. But if you look at it and you compare it to other media companies, it's definitely still a bit pricey. I think that there's still, I want to say that this fall is in a way justified with the change in growth rates of their revenue. So I am a little concerned that the market is really going to start to get more aggressive with repricing growth. A lot of these growth stocks, you know, they're treading water with their revenue growth coming from mid double digits, you know, high percentage revenue gains. And now we're really starting to see that compress. And Netflix is definitely the poster child of what the market can do if you don't perform. And I think that we're in for another crazy earnings season. It's going to be quite interesting to me to see, because Facebook and Netflix were kind of the ones moving together, and it's going to be very interesting to see what happens with Facebook.
I guess can we call this quarter like put up or shut up? Any disappointment, things are really going to get hammered.
Yeah, I would say so.
Yeah. Cool. I just want to give a shout out to Tristan. He said, shout out to Travis for the maps pick, almost a 2x in less than a quarter. Yeah, that's awesome.
Yeah, Maps has been an interesting one. We've had a roller coaster on that one. We bought it in the initial SPAC deal, I think, over a year ago. It went up more than a double, took some profits on it. Then it came all the way back down, had a massive drawdown, and is still below the SPAC price now. But I think it's actually an interesting value. But it is a 420 stock. It is a company that is a provider of software and marketing for dispensaries in the cannabis industry. And I still think it's actually pretty well positioned for the long term. It's got positive cash flow, profitability already, lots of growth opportunities ahead of it. So I still like it fundamentally. And on that note, actually, as well, I've got a perfect 420 stock pick that we'll talk about later.
Let's hear it.
You want to hear it now?
Yeah, man, let's go. It's 420. Let's light it up.
All right, let's light it up. Well, yeah. So one of the other companies that I own in the cannabis space is actually an ETF, the MSOS ETF, and it's a ETF that holds a basket of cannabis dispensary operators, mostly operating in the U.S. The MSO is multi-state operator, is what that stands for, but MSOS is the ETF, and it holds companies like Trulieve, Green Thumb, Verano, Cresco, et cetera. These are like, you know, owners of a bunch of different dispensaries across different states. And the reason I like it, it's down a ton. You know, we've actually got
70% off all-time highs.
That's right. So I think it's an interesting entry point here because the valuations on a lot of these MSOs are actually pretty low. They're profitable companies that are trading for like 8 to 10 times EBITDA on average, which is a pretty good multiple considering I expect them to grow for the next decade plus. And we've got a lot of potential catalysts here in this industry. Of course, we've got, you know, maybe deregulation happening at the federal level. We've got potentially safe banking which could open up, more banking opportunities for a lot of the dispensaries so that you don't have to just pay cash or use high expensive ATMs when you go into these dispensaries. So there's a lot of positive catalysts ahead. It's been frustrating on the regulatory front because, the federal government just keeps whiffing on cannabis legislation, and they keep saying they're going to do it. It keeps not getting done, even though I think something like 70% of the country is in favor of deregulating or actually legalizing cannabis. So the people want it, and the federal government just seems to be inept once again at giving it to us. But at least some of the states, we have more and more legalization happening for both medical and recreational. So yeah, I mean, I think cannabis has got a bright future ahead, and MSOS ETF is priced for max pessimism right now. So I really like that ETF. I also like some of the individual companies within that ETF, like Trulieve or Verano, et cetera. So that's, I think, a great pick for today, 420.
I love it. There seems to be a common theme right now, which is the mass majority of people want something and the government says, not for you. I'll give you another example. We can tack on to the 420 weed friendly cannabis ETF is, where did it go? A spot Bitcoin ETF here in the US. Wouldn't you know, the SEC keeps pushing us off, but Australia is about to become the 8th country to approve a spot Bitcoin ETF, and the US is just going, none for you. So this is good to see this development. But I wish the US would start listening to what the people want.
Well, this has to be putting pressure on the SEC. I mean, as developed country after developed country comes out with a spot Bitcoin ETF, I mean, what is stopping them at this point?
Market risk.
Well,
I mean, if you look at like all of the tweets that Gary Gensler's tagged in, I mean, it's crazy. I can't believe they're still fighting it.
I would imagine that the more developed countries coming out with this, that's going to put pressure on the SEC.
Yeah,
I would think.
absolutely. I mean, it's only a matter of time. It's just like, come on, guys, let's get the show on the road.
Yeah, help us out in retirement accounts. Come on.
Yeah, I mean, we've talked about this endlessly on the show about what happened to gold when the gold spot ETFs opened up in the early 2000s and how that created a boom. And all of us Bitcoiners are just kind of sitting back going, let's do it. Let's make it happen. So, all right, let's just hammer some news and a couple of things that we want to talk about. And then we want to get to you guys and answer some questions live. I don't remember when the last time we actually did a live show was. We've been pre-recording them because we've been traveling and moving studios and offices and all that stuff. But we definitely want to get to some live Q&A today. By the way, go ahead and like this up, guys. I know YouTube has recently over the past few years has been shadow banning a lot of crypto tags and content, especially live streams, because there's so many live stream scams in the crypto space. So hit the like button if you haven't done so. So the people that actually hit notification will actually get notifications. But yeah, with that said, let's go ahead and jump into some news. One thing that I thought was kind of interesting, this week, there was a Vice article that came out kind of exposing, talking about crypto scams. I have a video I'm going to launch on my channel on Friday where I'm reacting to a bunch of crypto scams, recent ones. But I thought this was kind of interesting to talk about because by now, I think most people in the crypto space understand that a lot of influencers get paid to tweet and talk about certain crypto projects, be it an NFT or, the old school ICOs. And there was actually a shill list that was leaked that shows how much certain people are charging for different types of promotions. And I just think this is kind of disgusting. And this is why I always say, like in the crypto space, you don't want to trust anybody. Like you have to approach it with adversarial thinking, right? Anytime you see somebody promoting a coin or an NFT, ask A, are they getting paid to talk about it? And B, like, are there any other ulterior or kind of scummy motives involved? And it's weird because every market cycle we go through, I always say people are going to eventually learn what these scams are all about. And eventually people are going to catch on and they're not going to work. But it seems to me like every cycle, the scams just keep getting bigger and bigger in dollar value and just sucking more and more newbies into it. So I don't know. I just wanted to point this out and just kind of show how I think it's just so disgusting.
Man, I was even getting added on Twitter by a bunch of moonbirds, like crypto bots last week, which was unusual for me because I'm like a stock account that rarely talks about crypto. But it was like all these bot accounts were adding me in these like NFT moonbird like scams, or I don't know if they're full scams, or Moonbirds is probably a legitimate project, but whatever they're doing to market it was pretty scammy.
Yeah, I mean, even what's his name? Floyd Mayweather is doing, I think, his second NFT, and the first one, the first project that he had, he just bailed on, and people forget. Like, and I think he made like 5 million on that first NFT thing. People forget he was sued a few years ago for shilling ICO scams. And yet again, people just continue to buy this stuff, hoping to get rich quick. It's a very strange market we're in.
You could thank
Well,
the internet for all that.
I would love to see Twitter or, YouTube or any of these platforms, Instagram, at least do one little thing to try to clean up the bot scams and just the constant stream of scamming that happens on these platforms, impersonators. It's like, we haven't talked about the whole Elon Twitter saga, but maybe this is a good segue for it because
let's bring it up.
I mean, one of the things that he's been rightly critical about Twitter is that, there's all these scams on the platform and all these, especially for him who, has thousands of comments whenever he makes a tweet. Some of the top comments that end up getting upvoted by bots are these like ETH scams or, these different types of like scammers that play in his comments. And so like Elon, one of the things he's tweeted about in the past couple months, some of the criticism of Twitter is that, hey, they're not doing anything about these bots. And I actually tweeted about it yesterday or day before on my Twitter account as well, because I saw another tweet from someone, these crypto scams, some of them, the comments are just like at all these different accounts. There's not even any text to the tweet. And it's like, how hard would it be for Twitter to create a simple filter to just, hold or not allow a tweet that only ats accounts, right? And maybe you need to work on that a little bit. Maybe there's some legitimate tweets that just have ats, but I mean, there are all these other signals, and I posted some, on my tweet about why, it shouldn't be that hard to filter out like maybe 80 to 85% of all like impersonators or bots just based on a simple list of 10 or 20 criteria. And sure, the last like 10% of impersonators or scams are going to be hard to catch with automated filters, but if you could eliminate 80% of them right off the bat, just by, how old is the account? Like, when was it created? How fast did they get their follower count? How fast did they do their following? Do they have is their bio exact matching some other user, especially a verified user's bio, right? Those are just very simple ones right off the top of my head. And I tweeted about, some of the other ones. It could be, stuff like, the location of the account, even the IP address. Does it match like, is it from a known scamming area, right? And so there's all these like signals that one could use. Like if you look into the reply on that tweet that I replied to, sorry, not that one, but the my own reply to my own tweet, I listed some of the just ones I was brainstorming, right? Like high DM activity, any account that was just created that's sending a ton of DMs at once, right? That should be a signal in an automated signal catcher, right? That should just be able to filter that out, or at least put it into like a penalty box for some amount of time. So, I don't know. I don't know why these companies that spend $1 billion on R&D can't figure this out, in a week.
Do you think that part of the problem is that they would, if they cleaned up their followers and cleaned up the bots and cleaned up the impersonators, they wouldn't have the user growth?
Engagement, like metrics would go way down.
Metrics would shift, therefore that would spook investors. So are they really truly motivated to give a crap about bot accounts that are being created if it's helping their user numbers?
Yeah, I think that is the big argument that I've heard as to why they don't clean it up. But look, it's short-term versus long-term thinking. If you're really a long-term thinking company, the health of your user base and the activity and the engagement of real users benefits from not having bot accounts and people getting scammed out of money, right? So yeah, I mean, I agree. I think that's probably a big reason why they don't do it, but it's very short-sighted. So yeah, I'm actually rooting for some of Elon's, I guess, Well, not that he's laid out his exact plan for Twitter, but some of the criticisms that he has, at least I am rooting for some of those things to happen. Like, hey, help fix Twitter's culture, outline the policies for, banning accounts more publicly, right? All the things around cleaning up the bots, maybe addressing some of the overspending and laziness at Twitter, where they can't actually get product features shipped that users want, like a short-term edit button, right? Or things like that. So I've been critical of Twitter as well over the past several years, even though I'm a shareholder and we've made money on it. It's a company that has just vastly underperformed its potential. And we can talk more about the Elon bid, because I'm not like 100% pro Elon on this Twitter bid, but I do think there are some things that he's bringing to the table that I like, because frankly, he's shaking things up there.
Yeah, Robert had a good suggestion. He said, filter out first-time live streamers with no prior history. Right. There's all these simple things that they could do. And I feel like all of the platforms are complicit, right? It's not just Twitter. It's Instagram, obviously Facebook, YouTube, right? YouTube comments. Like, I kind of gave up trying to moderate them, because if you look at any large channel, as soon as they post a video, it's like 50 to 100 crypto scam comments. It's like, this shouldn't be this hard to filter this out.
Even small channels, like my channel's not that large, but even I have that stuff. It's like, it's everywhere. And
Yeah.
I think that it's affecting creators, because I know personally, and you too, Chris, with the Instagram stuff. I mean, the Instagram impersonators, you really can't figure it out. Someone with the same username, words, and the same pictures and the same posts. You can't figure that out. Like, how, and it's really pissing off creators, and you can't get verified. So
Yeah.
it's risking your name and your reputation. And I think that if these companies want to help creators, they need to figure this out, because we're just going to leave.
Yep. All right, let's go ahead and move on. I know we've talked about our annoyances with the impersonator problem for many months, and nothing seemed to change. But I don't know. I know Elon taking over Twitter has become kind of a political issue. I know the right is really interested in that. Trav, anything else you want to add to the Twitter space before we move on?
Yeah, well, I thought it was interesting that even the Florida governor yesterday was weighing in on Twitter, because the Florida pension plan has a little bit invested in Twitter. And so they're saying, if the Twitter board doesn't accept Elon's bid, then, they may go after the board. So I saw this sentiment on Twitter. And I think it's worth addressing here. I think it's worth letting everyone know, Elon's bid was not a binding offer. He doesn't have financing lined up yet. And frankly, the board, can't just blindly accept an offer that's not a binding offer right off the bat. They need to go and see if there's other bidders out there who would bid a higher price, right? They have to go through a process. So that's what they're doing now. Like, I think we need to give the board some space to do that. The poison pill, it looks sketchy, but part of the reason they do that is so that while they run this process to try to potentially look for bidders for the company, no one else can gain like a massive, stake in Twitter while they're doing that and disrupt the process. So in this case, I think that if Elon steps up and he has legitimate financing at some point and he makes a more defined offer, and especially if he has, credible partners and a credible plan for what they want to do, then I think, the board will potentially go forward with that. But you have to realize that Elon stepped up with a bid that didn't have financing in place. And granted, he may be able to get it, but he doesn't have it yet. And also, the board has to consider other offers in the meantime as well. So give it time. We'll see how it plays out. But, I don't think the board is going against their fiduciary duty just yet. We'll see how it plays out. If they do go against their fiduciary duty, then obviously there's some things that will happen there from a shareholder perspective. But all of this, political, hand wringing about what's going on with the board and Elon and Twitter is premature. So let's just hold on that. I think, by the way, if you want to read deeper into some of the legal implications of all this, the best articles that I've seen on this are from Matt Levine on Bloomberg. He writes an article or a column called Money Stuff, and it's one of the best columns of any financial publication out there. Just consistently awesome. It's not only informing but hilarious. But Matt Levine at Bloomberg writes some really great stuff on this recently, so go check that out. But yeah, I'm expecting maybe we'll see some other bids emerge for Twitter from private equity or a strategic bidder. But it would also be interesting to see Elon, get more serious about his bid, and we'll see what happens. He's also talked about doing a tender offer and just going direct to the shareholders with with an offer. And if he does that, he'll have to have the financing lined up for that. So TBD, we'll see. It's going to be really, really interesting and entertaining to watch.
Well, we'll keep our eyes on it. All right. In the spirit of looking at the markets as a whole, there's a few things that are really moving and shaking right now. Housing, a lot of people are starting to freak out about real estate. Also, retail spending, and a few other metrics that are kind of potential bellwethers for bear markets. Nikki, I know you wanted to talk about consumer spending and retail sales, stuff like that. What are you seeing, and what does this mean to you?
Yeah, so I did a video on my YouTube channel probably a few months ago now talking about kind of how I see the economy going forward and how the Fed and all of this is going to work together. And one of the points that I made was that I said the consumer still has room to add more debt to their balance sheets right now. They paid down a lot of debt, with the stimulus. And now I think we're going into that trend and we're seeing it come to fruition where if you go to the Wall Street Journal, I think it was a Wall Street Journal article, and you scroll down a little bit, you can actually see a little visual showing that credit card spending is increasing. And this is happening across multiple different banks, Bank of America, I think this was JP Morgan and Chase. And we are finally starting to see the consumers start to take on more debt to, kind of survive and keep up with what's going on with inflation. And as far as, retail spending goes, if you look at retail spending on, I think there was a Y Charts graph that kind of compared this. By the way, shout out to Y Charts for sponsoring the show. But this is actually, if you look at retail sales, it showed, positive. But if you actually take into account inflation, retail sales is negative. It's going negative. So it's the consumer is essentially spending less on a real basis if you take into account inflation. And but we're starting to see debt levels increase, and we're starting to see savings rates come to some particularly scary levels, in my opinion. I think that savings rates have been pretty steady. We're back to pre-pandemic levels, but if we start to see savings rates go lower from here, that's going to be quite concerning to me. In addition to taking on more credit card debt and taking on more loans, so that's kind of what I'm watching. And I anticipated that this was definitely a possibility, just based on it. It's not rocket science, right? Mark, the government gave about a bunch of money, consumers became healthier, and now consumers don't have the extra money, and we have inflation, and now consumers are having to not only potentially they are taking on more debt, but also potentially save less. So that's what I'm going to be watching over the next few months to see how those trends continue. I mean, we overall are still seeing a healthy consumer, assets, cash that they have in the bank, things like that. But that's what I'm going to be watching.
I thought inflation was because Putin invaded Ukraine. Is that not the case? I thought is that not the narrative?
Oh, come on. We talked about this last week. We know that the well, I won't go there.
Yeah, for anybody that missed last week, I mean, basically the whole narrative was the Putin price hike, and we just showed how obviously, you can't print trillions and trillions of dollars and then expect no inflation. And unfortunately, we are going through the discipline or the problems that are caused by all that reckless spending. So I don't know. Trav, anything to add on the economic side, the macro side with the consumer, retail, anything like that before we talk about housing?
Not a ton. I mean, basically, what the government gives the market, the free market is taking away here. Like Nikki mentioned, it's just a reversal of all the income gains that we saw during the pandemic starting to get eaten away by inflation. And I'm still, concerned about what's happening in China with regard to supply chain issues, still concerned about like longer term energy implications and things like that. So we'll see how it plays out. I don't think it's the end of the world, but the consumer is definitely going to take a hit here, probably in the short run on, just inflationary pressure. So that I think that trend should continue. Whether or not we go into recession is still an open question. I think we'll know a lot more about that in the next 6 to 12 months, but at least we are coming at this with a relatively healthy consumer and a low unemployment rate across most countries. So hopefully if it does happen, we'll have a relatively shallow recession, and then we can work ourselves out of it and get growing again. But yeah.
Benjamin said the Putin price hike didn't work. We're doubling down on corporate greed. Yeah, that was the other scapegoat for the inflation that we're seeing. All right, let's talk about housing. So, housing has just been absolutely insane since COVID, right? Everybody was leaving cities, buying bigger homes, looking for more land. Prices have been nuts. We've been talking about people getting priced out. Well, now we have rates going up, and thinking about what the implications of that are, Preston tweeted earlier that, this chart just showing the existing home sales kind of coming off of a top, and the Freddie Mac US Mortgage Market Survey. So basically, potentially could be a leading indicator of falling demand for prices. Also, there have been some tweets, and some of this is a little loaded, but there's a lot of focus on this at a minimum, right? In California and in certain areas where there's maybe more jumbo loans being done, you're seeing rates in the 6% range. Absolutely, we're within the 5% range, which is putting a squeeze on affordability at really all levels. But I think this is something to not be underappreciated, because small incremental increases in mortgage rates have dramatic effects on affordability. And so even though, it doesn't sound like that big of a difference, 4 to 5%, maybe creeping up into the 6% range on an affordability basis, and the ripple effects that could happen on prices, I think that could be a really big effect.
It's a huge deal. And if you compare, the interest that you pay over the life of the loan compared to where we were not that long ago, it's a lot of money. That's money that could be invested and grow and compound for you, that ends up having to be paid as interest on a cost. So I think that this is a huge deal for the consumer, and I don't see how this doesn't affect real estate valuations, at least on some level, but to be seen.
We already saw an article in the Wall Street Journal this week that prices are cooling in some of the hot markets, like Boise, Idaho, for instance. They called out specifically. Now, it could be a little bit of a lag, but I do expect that we will see, if not price declines in some areas, at least price increases start to cool off, because like you said, this directly impacts affordability when you have mortgage rates double. So yeah, I think it's something that the market has already kind of figured out. By the way, the housing and home building stocks have been under pressure for the past couple of months. So, the market has already sort of figured that out. And the question again is how deep does it go and how bad does it get? I don't think we're in store for the type of, home price declines that we saw during the 2008 crisis.
No.
But, I do think we'll see the markets cool off, which I think is probably healthy. We saw some markets last year, including Austin, where I'm at, just go up at insane levels. We had home price increases in some neighborhoods of almost 50% on a median home price basis. I think the average was like 20 or 25% last year. So these cities like Austin and Boise and Raleigh and wherever else are due for a cool down. And I think that's overall pretty healthy.
Yeah. And I guess we can't forget the fact that there's still a supply problem, right? Like there's still just not enough housing, and COVID made that situation even worse. But just to show kind of an example here. So if you look at, say a $500,000 house with 20% down at 3.5%, that's going to put your mortgage payment at about $1,800, and you're going to pay, call it 250 grand in interest. Right. If you bump that up to say 5.5, which is kind of where we're getting close to today, that goes up to almost 2,300 a month and over 400,000. So it's significant over the course of the life of the loan. Right. And a lot of people don't care. The average person just says, hey, what can I afford? What's the maximum amount I can qualify for? And then they get, house rich and cash poor. But the wise people that think about total interest paid, this is significant. So I think it's something to pay close attention
It's
to.
like a whole second house in interest.
Yeah.
I mean, even on the monthly payment, that's almost a 30% increase in the monthly payment. So yeah, I think, anything above a 20% increase on the monthly payment is definitely going to have an impact.
Yeah.
And Tristan in chat said, how high do you guys expect interest rates to rise to? I think that's a good question.
Ooh, that is the $1 trillion question.
I feel like the market has kind of, in the beginning, the market was calling the Fed's bluff that they were going to raise rates so aggressively, but seems like now it is more probable that the Fed will stick to it and they will continue to. I think we're looking at what, 0.5% on the next Fed decision, I think.
Yeah, there's like a 90% chance priced into the futures markets now for a 50 basis point hike at the next meeting in May, and I believe over 80% chance of another 50 basis point hike at the June meeting. So yeah, certainly the market has priced that in. And if you look at the 30-year mortgage rate, it's now pushing almost 3%. In fact, it did breach 3% earlier in the week.
I mean, the 30-year bond rate?
Yeah, sorry,
Okay.
the 30-year government bond yield, which of course is going to be one of the bigger drivers of what that 30-year mortgage rate looks like. All of the 30-year mortgage rates are essentially indexed off of what those 30-year U.S. government bond rates do. So I expect, in terms of absolute levels, I'd be surprised if we see the Fed allow the 30-year government bond rate to go over something like 4 or 5%. So I do think we'll see mortgage rates top out probably around like 7 or 8% at a max. And why do I think that? Well, I think the government will step in and do what's called yield curve control, where they start buying bonds again or influencing yields again if they get too high, because frankly, the federal government doesn't want to pay that type of interest on their debt. And, we can talk about the implications of that, of course. Like if you start buying bonds again, then you're just back in QE. But I'm not saying it's going to happen next month, but I am saying like if we saw a sustained rise in the 30-year yield, to beyond 5% or say somewhere around that level in the next, 12 months, I think that level of rapid rise would concern the Fed, and they will have already achieved their goal of cooling markets at that point. I mean, if we see the 30-year yield rise to 5+%, then equity markets are probably going to be down more than 20 or 30%. So the financial conditions will have already cooled, and then that will give the Fed room to probably, start to make changes again. But we're a ways off from that. But I'm saying I think I would be surprised to see in the next 12 months yields rise above, say, 5% on government bonds. But that's because, again, the government isn't going to allow that to happen because of the implications it will have on government finances as well as, corporate finances as well, because corporate bond rates will index off of those rates. So
good point. Tiger Ram says, I'm in Canada. I'm hoping for an 08 situation. And maybe that's why we won't get one, is because there are so many people sitting on the sidelines. And I feel especially bad for people in Canada. I mean, the affordability crisis up there is way worse than in some areas of the US, right? Obviously, we have our markets that are still way overpriced, but in Canada, across the board, I mean, when you look at average spending compared to the average cost of a home, I mean, those are way out of whack. But yeah, I don't know. I mean, I think for the millennial generation, like a lot of us have just been sitting on the side saying, hey, when are things going to come into my affordability range? And that's why, you see these markets and these videos of places where there's a listing under 300K and there's 200 people standing outside the door, right? So until that supply goes up, I don't know how that problem gets fixed.
We did see some evidence that I think in the home building numbers that we are starting to see some supply increases hit in the US market. I'm not clear on the Canada market though. I haven't seen that data yet, but we could take a look at that. But yeah, we actually have seen a pickup in activity in US home building just recently. So perhaps that supply will help the situation a little bit as well, but sort of bad timing, right? Like all that supply may come online just as consumer, affordability takes a hit. So yeah, it could be a little bit of a time period of correction for the housing market for some amount of time.
Yeah, I've been looking at housing starts and a few other of the builder metrics, and things are catching up slowly, but I don't think at fast enough of a pace. And it's creating even more of a run on it with interest rates going up. People are trying to panic buy, and I don't know. It's a strange situation. You guys want to do some Q&A?
Let's do it.
All right. Let's see. Boo Lumen says, Travis, nuclear popped in the news cycle right after last week's episode. Yeah, you were talking a lot about nuclear power and what could happen with that. Kind of interesting.
Yeah, we saw some big news out of France. You know, the presidential candidates there are pushing nuclear pretty heavily, and I think we'll start to see that. We also saw some news out of Japan that, you know, they're becoming more pro nuclear again, even though they had shut a lot of their reactors after Fukushima. So yeah, the world is starting to shift, and I think that's a great thing. Like, I don't think that we really can have this transition to renewables without baseload power that is dependable. And so, you know, we're going to need nuclear as part of that solution. So yeah, I think France, like Le Pen, who's the far right candidate who's challenging Macron, she is looking to build 20 new reactors in France in the next decade or two. And at least that's her plan. And I think Macron followed up saying he wants 15 to 18 new reactors. So yeah, there's a lot happening. That New Scale Power is about to finish its SPAC transaction. It'll be interesting to see how that one trades post SPAC. I mean, if it trades down significantly after de-SPAC, I'll probably end up buying some, even though, you know, it is a longer term story. It's not one that's going to be generating a ton of cash flow right off the bat, but they've got a long backlog, I think, coming of contracts and good news in that sector. So it'll be interesting to follow that.
Absolutely. Next question. Have you invested into any NFTs yet? I guess I'll start. I have not made any meaningful moves in NFTs. My focus has been on markets that have tradable tickers. I just had a lot of conviction that over the past year, we were in a massive NFT bubble. And if you look on, let's just take a look at the homepage of CoinDesk. The top the number 3 most read article is about Jack Dorsey's first NFT tweet that went for sale for $48 million and ended with a top bid of just $280, right? How many times did we warn about this over the past year, that this stuff was just a massive bubble? You know, when you're walking down the road and you hear, you know, just random normies talking about NFTs, that's how you know things are probably overheated. Now, granted, even though they've had a boom bust cycle, that doesn't mean I'm bearish forever. It's just I'm looking for things that have real utility. I'm not a JPEG hater, but I don't want to, quote unquote, invest in something that volatile and that speculative. I like to look at a chart and be able to base my trading and investment decisions based on something that has A, liquidity, B, price history, right? So when I look at price history, I can base risk and reward off of price areas, off of trends, off of different technical indicators. I can look at fundamentals. With NFTs, I guess I just don't love them enough to just throw a whole bunch of money at JPEGs. But, you know, we've talked about some of the spaces that we are bullish on and some of the things that we think are sustainable over the long term. I think the next NFT market cycle will be more sustainable. And a lot of the stuff that had the biggest high flying prices, some of that will recover, but I think a lot of it will never recover. I don't know. Do you guys have any other opinions on NFTs?
I mean, pull up a Google Trends chart for the term NFT. It'll show you right there how enthusiasm went parabolic late last year and has really tailed off. And, you know, of course, who knows what the trend will be in 6 or 12 months, but it's very clear what it is now, that it's cooling. It's always a story of demand and supply. You know, you had relatively constrained supply at a time when, you know, people were just waking up to NFTs last year. And now you have a ton of supply that's now hitting, with all these projects finally starting to produce and mint. And so inevitably, you're going to have a cooling off of the market if there's way more supply, especially if demand cools, because, you know, there's concern obviously about other financial markets going down this year. And if crypto and stocks are weak, well, then NFTs could have a hard time. So there's always going to be projects, though, that are so highly in demand that, you know, they're probably going to do well right off the bat, right off the mint. So, you know, I think there will be stories where the NFTs will still, there's still going to be headlines where, oh, you minted this NFT and it was up 20x in a matter of a couple months, right? That will probably still happen. But as a general asset class, yeah, I think, we saw probably a peak hype cycle late last year. And now we've got a lot more supply coming on. So you have to be a lot more discerning, I think, about where you're investing in the NFT space. And like Chris says, I mean, we're still expecting a lot of interesting things to happen in NFTs outside of just, JPEG projects and avatars, and, into things like play to earn games and NFTs that confer different advantages to like, social aspects, DAOs, all that stuff, right? All the Web3, when you broaden it to Web3, there's still a lot more that's going to be done. And we're just in the early stages of that. So certainly I'm not the NFT or Web3 expert. It's probably an area we need to dig a little deeper in over time, but
yeah, this is kind of an example of kind of the waning demand. So this was posted 3 days ago. After making millions on his last NFT project, Mayweather has once again released another one, but this time only got 118 minted out of 5,000. And you can see they were selling them for, I think, a third of an ETH. So basically $1,000. And he said, the last NFT project, he made almost $5 million off of it and then completely abandoned the project, right? This is what we're seeing so much of. And remember, he's been fined by the SEC for promoting scams, but it looks like he doesn't care. So, like, look, people, every market cycle, there's a new round of newbies and there's new dumb money that comes into the space. And I think this is why it's important for us just to point out this stuff and point out the difference between things like hard money, Bitcoin, right? More venture capital risk level stuff like ETH and ETH competitors and that space, right? And then stuff outside of that, NFTs, even higher risk profile. So it's not that any of this is good, bad, or indifferent. It's just different risk profiles. And I think you've just got to decide, where do you want to sling your money? What's your risk tolerance? And for me, I just like looking at stuff and investing in things that have price history and liquidity. And a lot of the NFTs are just too wild. They're too volatile. Could I get lucky, make a few $1,000,000 on something? Sure. I just know what works for me. And I think everybody should just go to where their core competency is.
It feels like the volatility of NFTs makes Bitcoin look like bonds.
Yeah, well, yeah, if you look at Bitcoin's price over the past year, that's certainly true.
Well, I want to take this next question. Jay Praz asked, it appears that the Dow is outperforming the NASDAQ over the last few months. Do you think that this is a multi-year sector rotation or will revert back to the 20-year trend of tech outperformance? So this is an interesting point because this has kind of been going under the radar a little bit, in my opinion. We've got stocks like Walmart. We've got stocks like Johnson & Johnson, Procter & Gamble, even Ulta making all-time highs. So, when we look at how the Dow Jones is actually built, it's compared to the NASDAQ, it's a lot less companies. So the Dow has, I think, around 30 companies in it, and the NASDAQ composite has 100, so around 100. So they're, the Dow is a little less diversified and it's more concentrated on those household names. And the companies that the Dow invests in right now, a lot of them are just doing really well. It's consumer staples that people are starting to rush to put capital in to get, consistent dividends, and companies that are going to stand the test of time as people flee, from these high flying growth stocks into safer capital with all the unknowns with a recession. So that's why the Dow is outperforming the NASDAQ. It's just a factor of the companies that the underlying indices are investing in and the amount of them and the types of them. So that's why that's happening. And as far as if this is, going to be just a rotation for a while, or if we're going to see us revert back to tech, I think that we are in a situation where people are looking for security in their investing. And this is showing it with a lot of these consumer discretion or consumer staple businesses hitting all-time highs. And what I think is going to happen is it's going to shift again, likely, right? If maybe the Fed doesn't get as aggressive as the market thought, if maybe a recession doesn't come, or it's maybe as not of severe as a recession as people thought, the consumer was more resilient than people thought. All of this can shift this again, and people will start to rotate out of these companies, and they're going to go back into the things that are going to provide higher growth. So I think that right now this makes sense that this shift in this sector rotation is happening. But I do think that depending on how things go over the next year, we could see another rotation pretty easily. And I don't think tech is dead. I think that tech is still, there are plenty. I think we're in a stock picker's market in terms of tech right now, and there are plenty of opportunities to choose from for long-term opportunities. But I think that we definitely could see that shift back depending on how the next year goes.
I think we're probably in a different environment. I don't think we're going to see a repeat of what we saw over the past 2 years. If you look at what happened in 2000 to 2002, when we had that massive shift out of tech and .com stocks, and the market sold off, frankly, for several years. But really within the market, there was an interesting shift from growth to value. So you had all these, futuristic .com stocks that went down 90, 95, 100%. But you actually had a number of stocks that did very well, even during the bear market, that were in sectors like, utilities, consumer, especially like staples and things like that Nikki called out, that are often a big part of the Dow. You had industrials and even, some of the gold stocks and stuff doing well. But yeah, just generally, if you look at value versus growth, if you look at stocks that are, actually generate cash flow, that trade at, below market multiples, the relative performance of value versus growth in the 2000 to 2002 timeframe was unbelievable. Like, growth stocks did horrible, value stocks did great. And we've already seen that happening over the past few months here. You look at like single digit PE stocks in a lot of different sectors, and they're actually performing quite well. A lot of them are up year to date, while we have, a lot of tech stocks that are down 20, 30, 40% or more. So I think, given what we're seeing with the inflationary backdrop with interest rates, this isn't just like a short-term pullback. I think we are in a different market environment than we have been over the past couple of years. I truly believe that. I don't know exactly how much value is going to outperform growth, but, I do think that we have a pretty good setup for value to outperform growth for a long while now. So just like we saw in 2000 to 2002.
Well said. We've got a bunch of questions about some crypto stuff, so maybe I'll hit those real quick. Thoughts on the FUD around Terra buying tons of Bitcoin to back their stablecoin, long-term risk? Yeah, I don't really have a strong opinion about that. I mean, I think it's bullish for Bitcoin. Anytime you have a large entity that's sucking up hundreds of millions of dollars or billions of dollars worth of Bitcoin, there's definitely inherent risks in algorithmic stable coins. We've seen some of those problems with DAI and, a few others over the past like several years. Obviously, there was a lot of FUD around Tether. And look, I mean, there's an inherent level of risk in all stable coins, especially from like the regulatory side. I think we're going to see a lot of not just direct slapdowns, but maybe tightening controls, at least here in the US, on that stuff. Do I see any outlandish inherent risks with it? I don't think so. I mean, every time there's a big project like that, there's always uncertainty and doubt, as there should be. But I don't see anything that's just screaming red flags to me. Next one, favorite level one that's not Ether. I like FTM due to low transaction costs. Yeah, I mean, look, I put all ETH competitors in the same bucket, and I don't try to guess which one's going to win. I've read a ton of white papers, looked at the communities, the dev teams. I just kind of look at it all and say, okay, what are the true use cases, right? There's some of this that doesn't need to exist at all. And then trying to pick a winner, to me, is kind of like going to a horse race. I can make guesses, but at the end of the day, it's really difficult to know which one of these is going to win. So what I do is I take a smaller portion of my portfolio, I break it up into different capital buckets, or I break that capital bucket into smaller investments. And if one hits massive, hopefully it'll pay for the ones that fail. And I kind of leave it at that. I don't spend a whole lot of time trying to maneuver the levers of position sizes based on long-term holds. If anything, I'm more of a medium-term trader now. Like I trade the market cycles, and anything that I think has promise, I'll stack some on a hardware wallet. But outside of that, I don't try to really pick winners on a long-term basis. I mean, my attitude is I think most crypto projects are going to go to zero in the next 5 years. Right. We have survivorship bias on the leaderboards right now because you see the ones that are alive today, but what you don't see are the ones that have died or gone from, place number 13 on the leaderboard to 500, right? Or lower. So I think it's just important to know what's out of our control and what's uncertain. And yeah, I don't know. I think that's all I'll say about that. Next question, would be interested to hear your thoughts on Bitcoin being in a bear market. We never got back to the 0.7 fib levels, which usually result in an alt season. Is alt season out of the cards now? So I think we are still in what I call the phase number 5 in the market cycle. If you haven't seen that video, there's a video on my channel called like the 5 phases of the crypto market cycle. Phase 5 is when we are in high volatility and a lot of chop. Obviously, Bitcoin's been in the same price range for over a year. I'll pull this up. We've had the 45K magnet. We've been over, under. Most alts are down more than Bitcoin, right? There's a few that are kind of kicking the trend here or there, but Bitcoin is the DJ. And when the DJ turns off the music, the ravers, all the altcoins trying to party, they get demolished. They get kicked out of the club. And that's why we've seen so many down 70, 80, 90% or more. I think that it wouldn't be a bad thing if we were blessed with deeper prices on Bitcoin. But again, I'm not going to try to guess when we're in a choppy range. When we're in a choppy, volatile range and you try to guess when you're going to break out of that, that's when you get chopped out. Right. That's why choppy ranges are inherently choppy, is because you have people making trades and placing tight stops. And that is kind of like a self-fulfilling prophecy, which leads to future choppy price action. So, I think the biggest mistake you could make is to try to drill down intraday or, whatever, and try to change or trade the changes in moving averages and, RSI crossovers, things like that. Those strategies get demolished when prices are choppy. So to answer your question, is alt season out of the cards now? It's out of the cards until Bitcoin shows that we are back in sustained bull market. Until that happens, the capital, think of capital flow. The flow of capital is not going to rush back into altcoins in mass until Bitcoin is back in a confirmed strong momentum bull market, right? You can make an argument, if we fast forward a year or two and we're at 150K or higher, you could make an argument that, we never went into a bear market and this was just a pause and consolidation, which could be true. But again, I don't expect most alts to just start popping off until we get back up above 45K in Bitcoin. I don't know. Nick and Trav, any opinions on that one?
No, I think because that was the title of this live stream, right? We're like, how to survive choppy markets.
Yep.
So this is the perfect time to go into that. And I think that in both sides, a lot of people are challenged right now because there are chart setups for swing trades and trading opportunities. But like you said, the Bitcoin's the DJ in stocks, the S&P and the NASDAQ are the DJs. And until we are confirmed above or below certain key levels, all of this, it's like, just wake me up when we break above or below, and then I'll start taking trades. If you try to, actually ended up pulling my swing trades when the market showed that we were coming out of trend and we were going to chop around, which we've been doing, because I don't want to be a part of that. And you have to be okay with sitting on your hands for a while until the market shows you clear direction. And until then, you're just going to end up taking stops left and right because, like you said, that these broad markets are what determines if it's a trader's market or not.
Yeah.
And there are outliers. There are absolutely single outliers, at least on the stock side. I don't know if altcoins have been behaving in a similar way or not, but we've had outliers where stocks have performed completely opposite of what the broad indices are doing. And if you find those trades, that's great. But when you look at it as a collective, it's just best to wait until we're trending in one direction or the other, and then you start to put the foot on the gas pedal with the trades.
Yeah, that's a great that's a great point. Because you'll always have something that's moving, right? You'll have random pops and you'll have momentum that you can trade. It's just when Bitcoin is flat or bearish, here's what happens. You get a lot of this type of stuff. You get a lot of tweezer tops. Like if we go down to, if you look at ZIL, this is a real common price pattern.
It looks like GME.
Yeah. Yeah. What you'll do is you'll see a move of 2, 3, 4, 500% in a few days. And then just as quick as it went up, it'll get sold into, right? It won't have an immediate sustained trend. And so one thing you just have to be careful of in choppy markets is chasing this stuff. Now, if you're buying at accumulation range lows and you're waiting for things to wake up, that's where you find the best risk to reward. And you'll always, every single day, if you look at the leaderboard, well, I shouldn't say every single day, but most days you'll be able to find something that's up 5, 10, 20% or more. The question is it a high probability pattern, or are you fooled by randomness, right? There's a great book that goes into detail about how humans are pattern seeking individuals and will chase and we'll try to find patterns where there's really no significant edge. And so you've just got to be careful trying to chase when things are choppy, because chasers are usually the ones that get stopped out the most often. Day traders, where you're trading every day when things have no momentum, are also people that get stopped out the most during choppy times. Where you can make a life-changing amount of money is when you're patient and it's clear that the capital is flowing into crypto and you have dumb money rushing in and you have emotional money rushing in and you have sustained trends over the course of several weeks or months. That's where you can make a career's worth of profits in a short period of time, right? You can make more money in 1 week, month, or year than you could potentially make in the next 10 years if you time it right. That's how I think about it, right? But a lot of newer traders, they want to come in, and I've seen so many YouTube videos talking about my $100 a day crypto trading strategy. Bullshit. That might work for a week, a month, or whatever. But if you go into the markets with a daily profit goal, you are going to lose over the long run because you're going to force trades in the wrong market environments, right? The way to really make a shit ton of money is when all the stars align and you have really great setups combined with the right market cycle, combined with capital flowing in, and you start nailing and pressing the gas at the right time. That's where you can really make a lot of money. And then you got to know when to pull back. You got to know when to press the brakes during choppy times. And the problem is a lot of people get bored during choppy times and they walk away or they rage quit and say crypto's a scam. And then they miss the best opportunities to start getting back in. And then they chase once things are already expensive and the early trend has already happened. So again, I'm a grandpa in the crypto space. I've been here doing it full time since 2013. I've seen it happen again. I know what works and I know what doesn't. And my goal is just to A, help people stay away from scams, and B, know when to press the gas and when to slam on the brakes.
Well said. Yeah. I think patience is really key in choppy markets, as you both of you pointed out. I mean, it also depends on what your style and strategy is. You know, if you're investing in your IRA very long term, still have many years before retirement, and you're, putting a little in every month into stocks and or crypto, you can sort of take a different approach where, like over time, it's probably going to average out and be fine. And as long as you're not making, any egregious allocation errors. On the other hand, if you're trying to trade choppy markets, I think you have to be a lot more strategic and a lot more patient about, where you're buying, what you're buying, recognizing the market environment you're in. On the stock side, for instance, I was just talking about value versus growth. So maybe, you start to look at what stocks are doing well in this environment. You could also recognize there's still a lot of room for some types of value stocks to run. So go look in that pool and see if there's some interesting stocks that are still haven't made moves there. Then you could also, on the flip side, go look at the stocks that are getting crushed. And maybe there are a few in there, similar to what we saw like in the dot-com bust, that are going to be survivors, that are going to be down 80, 90%, that will be amazing comeback stocks if you're willing to hold them for several years. If you buy them right on the, the bloody dips, and then you're able to hold them for, 2, 3, 4 years. And you can take a stand, you can draw a line in the sand, so to speak, and say, I want to own this at X price, and I don't care if it goes down more after I buy it. I'm going to buy this and hold this, and I'm okay with stomaching that volatility. Again, I think those are some different ways to think about it in different strategies. And so, for me personally, the way I'm handling choppy markets and stocks is, I have sprinkled in some value stocks. I even have some tech stocks that I think are trading at, below market valuations that I think could do well, that could be acquisition candidates. I'm also hunting opportunities in, some of the hotter areas of the market, like the uranium stuff, potentially the cannabis stuff, those types of areas that I think could be in favor. So some of the value stocks, et cetera. So those are just some ways to think about it. But I'm going to make some buys that I'll probably be taking some drawdowns on, that I'm going to be okay with, because I figured out where I want to buy those and where I'm comfortable buying those and holding those.
This is the beautiful thing about getting to a point where you can A, trade multiple markets, and B, have different time frames, right? Time horizons and goals for those strategies, right? Like what I was talking about was kind of shorter to medium term trading in crypto. And what you can do, and what Trav and Nikki do, is medium to long term, value plays, right? You can obviously take momentum, but there's different time frames where, say, altcoins are slow or dead. There might be areas of the stock market that are really ripe for opportunity. So obviously you got to start somewhere, and you don't want to try to do all things all the time at once. But once you develop your skill level to, you're like, okay, I know what I'm doing in crypto. I'm waiting for those setups. Let me learn value investing from Travis, right? Let me figure out how to take that portion of my portfolio and outperform there when maybe crypto's choppy, or vice versa, right? Maybe stocks are slow and overheated, and crypto's popping off, and you can make a lot of money taking shorter term trades there, right? There's always opportunity somewhere, and you've just got to know where to put your focus.
Yeah. And I think that something that we talk about all the time is diversification, especially as a financial planner. It's like, everyone's like, shut up about diversification. But look, like, we're seeing, I literally just got an alert that Walmart stock just made an all-time high, right? Like Walmart, it's carnage out there. And it's like, Walmart just made an all-time high. Energy stocks, what we saw go on with energy stocks, consumer staples, what we saw with just commodities in general. It's like diversification, if it hasn't, I think now it's showing that, and it's proving that in a way. So I think that anybody that is very focused on just one asset class, real estate, forgot about real estate, right? So anyone focused on just one asset class, I think that it's important to kind of step back from that and think a little bit more strategic about how you're allocated.
Well said. Well, guys, we've been going for over an hour now, so we'll start to wrap up. Let's see if there's one or two more questions that we can get to. Feel free to bring one up, guys. All right, let's see here. By the way, started watching you in 2015, back in the good old days when Bitcoin was $200, and your intro to buying Bitcoin video, which is still relevant today. Yeah. It's interesting looking back, 2015, nobody wanted to talk about Bitcoin. Today, it's like the hot topic. Let's see, Ripple versus SEC thoughts, regulatory certainty. Yeah, I don't know. I'm still kind of waiting. It seems like we're starting to see some inklings of precedents there. No strong thoughts. Jay Praz, what are your thoughts on the situation in China right now? COVID lockdowns and supply chain issues again. Do you think we're setting up for a potential Black Swan COVID 2.0? God, I hope not.
I don't think that the people would allow that. We would be like, screw you, government. We're living our lives.
Well, unfortunately, in China, they can't really do that.
I know.
Or else they get
I know,
murdered by their
I know,
government.
I know.
Travel, you followed the China situation closely. Or are we going in for more supply chain issues, or is this a short-term problem that will be quickly remedied?
Yeah, there's some serious problems coming to supply chains because of the China situation. But on the other hand, the Chinese demand being essentially locked out of the global market is also helping cool things a little bit. And you have a shift from a lot of spending in developed markets from goods into services now. So that all kind of helps alleviate maybe the what would be a very extreme, yet another shock to the supply chain system. So yeah, I mean, I think there's still going to be definitely some incremental impacts, like autos, for instance. You still have a shortage of chips and parts, critical parts in the auto sector, and that should continue through at least the end of the year, if not into next year. And even if demand cools, you're just not going to have you're just not going to be able to build what you're able to build. So I don't know. It's definitely not good. I'm hoping that this situation gets resolved relatively quickly. Luckily, we're also in a seasonal period where demand for goods isn't as strong. So again, I think you are going to have incremental impacts from the Chinese situation, but hopefully some other factors are going to help to offset that in the meantime.
All right. Well, with that said, let's go ahead and start to wrap it up. If anybody here is not in our community, I'll just show you this. You can go to wetalkmoney.com/community, and you can check out what our wealth building community is all about. We have a Discord channel. We do weekly live classes, alerts, all that good stuff. In the meantime, if you have any other questions that we weren't able to get to on the live show today, go to wetalkmoney.com. You can submit a question ahead of time for the show. And I know in the future, we're going to be doing more of these live streams. So hopefully you guys like this format. If you got value from it, tell somebody about it. Leave us a review on iTunes or Spotify. You can subscribe to the audio version too, if you guys are watching or listening to this in the car on your transit. And yeah, whiskey and wisdom. Yeah, we got to do some more of those. Those were always fun.
Yeah, people want to see you on with Carter again. He's a fan favorite. I saw some tweets.
I just talked to him yesterday, actually. So maybe we can get him on the show when we start traveling again.
Yeah, we love Carter. He's an awesome guy and a very, very smart guy.
Yeah. And if there's anybody that you think we should interview, that's one thing we're going to start doing too, is some interviews on this. I know you guys love looking at our three pretty faces, but yeah, if you guys have anybody else that you'd like to see on the show, let me know. All right. Well, thanks to Nikki and Travis for joining me today. And thanks to all you guys for watching or listening. And yeah, we will see you guys next week. Take care.
Have a great 420, everyone.
Yeah.
Happy 420. Blaze it up. All right. Take care, guys.